Okay, so we're still dealing with this question for Chimulenga company. We've made the trial balance. Now we're going on the second part to make the income statement. Income statement comprises of the trading account. The main purpose is to get the gross profit and the statement of profit or loss. Purpose is just get your net profit or your profit after tax. Okay, so this is the profit. Net profit is basically the profit after you've deducted all your operational, financing expenses and your tax expenses. Yes. So the key for these, for the income statement, is with these ones you're only dealing with expenses and income. In the balance sheet you're dealing with assets, liability and equity. Okay, so this additional information usually gets applied when you start the statement of profit or loss. Okay, you must read through. Sometimes there might be some adjustments that might affect the trading account. Okay, but in this case here, none of these adjustments affect the trading account. They will affect the statement of profit or loss. Okay, so when we reach the statement of profit or loss, we're going to do these adjustments. Okay, for now we need to make our trading account. We want to get our gross profit. Okay, so the first item in the trading account is your sales revenue. Okay, this is the money that you've made from selling goods or services. Okay, so you put here sales revenue 160,000. You have a component which is also called return inwards. This is what we call sales returns. If you see any return inwards, you should deduct from sales. Okay, if you see any return inwards, okay, you deduct.
What is the other term for return? What?
Sales returns. Sales returns. Sales returns. Okay, so if you hear sales return inwards or sales returns, it's this is a contra revenue account. So remember, in our diagram, revenue is on the credit side. So contra revenue reduces revenue, meaning it has to be on the debit side. So if you see return inwards in your trial balance, put it on the debit side. It's a contra revenue. It reduces your revenue. After you deal with if you have return inwards, you deduct from sales. Okay, in this case we don't have, so we go to our next section where we have to tabulate the cost of the goods that have been sold. Okay, cost of the goods that have been sold. Okay, so here pay attention. This is how it starts. First you begin with your opening inventory. Okay, these are the goods that you begin with at the beginning of the year. Okay, so we have opening inventory of 20,000. Then you bring in your purchases, because that year you bought some new goods to your business. Okay, you started with goods worth 20,000, then now you've purchased goods worth 98,000. Okay, so you bring in your purchases here. Purchases 98,000. Yes, is that a question? Okay, then if there was carriage inwards, you need to add it to your purchases expense. Okay?
Sorry, I want to find out something. Do these three columns start when they row the columns?
And
Do they have names?
No. What I can tell you is this last column is for grand totals. Okay. Then this column, this is just for adjustments. Okay. So this first column, you only see it when you're making adjustments for purchases. Okay. It's only purchases where you will see this first column being used. From then on, it will just be the second and third. So sir, they do not have names. Okay, they don't have names. Just think of these first two as the ones for adjustments, and then the other one for grand totals. Okay, so we add our carriage inwards to our purchases to get our total purchases expense. Okay, total purchase expense 100,000. Okay, after that we want to find what is the total cost of goods available for sale, meaning all the inventory that we had in our shop throughout the year. This is what this total cost of goods available for sale is. Okay, so you add your opening inventory, the goods you started with, plus your purchases, okay, to get the total cost of goods available for sale, 120,000. Okay, just added this opening inventory plus total purchases to get the total cost of goods available for sale. Any questions?
So sir, anything else that has to do with the goods has to be added to that?
No, anything that has to do with purchases. Anything that, because opening inventory to just stay there by itself, but purchases, anything that has to do with purchases, you need to add in, you need to make adjustments to the purchases. So if you see this one, return outwards, return outwards or purchases returns. This is when you return goods back to your supplier. So when you return goods back to your supplier, the purchases expense reduces. Okay, because you have taken some goods back, so you don't have to pay the full price that was charged to you earlier on. So if there's any return outwards, you have to subtract T. Okay, you add purchases plus carriage inwards, then you subtract return outwards. Okay, then you have your purchases expense. Okay, so once you have the total cost of goods available for sale, here remember colleagues, want to find the cost of the goods that have been sold. So in order to get the cost of the goods that have been sold, cost of goods sold is total cost of goods available for sale minus closing inventory. Okay, if you want to find the cost of the goods that were sold, it's the total cost of goods available for sale, all the goods that you had in your shop that year minus the goods that have remained. Okay, so when you subtract all the goods that you had in your shop minus the goods that remained, you get the cost of the goods that were sold. Okay, and in our additional information here, they told us closing stock valued at 30,000. So we're going to subtract this 30,000 from the total cost of goods available for sale. So 120,000 minus 30,000, we're going to get 90,000. This is your cost of goods sold. Then to get your gross profit, it is sales minus cost of goods sold. Okay, so sales 160,000 minus cost of goods sold 90,000, we get a gross profit of 70,000. And this is where the trading account ends.